partner and the co-chair of the Corporate and Securities Group at Glaser Weil, Fink, Howard, Jordan, and Shapiro in Los Angeles. We are a full-service law firm based in Los Angeles with offices in Orange County, San Diego, and San Francisco. I am also the president of the Small Public Company Coalition, which is a 501c trade organization that advocates on behalf of the small capitalization public company community, investors, issuers, and other members of the community, service providers, investment banks, brokerage firms. And we are, to my knowledge, the only registered lobby group for this industry in the United States. Let me go ahead and introduce my panel. I'll start with Cromwell Coulson. Cromwell is the President, CEO, and Director of OTC Markets Group. Paul Dorfman, who is the Head of Listings at the New York Stock NYSE American. And Philip Shum, who is a Director of Listings Development at the Canadian Securities Exchange. Gentlemen, thank you for being here. So, we're here to talk about advocacy for the microcap community and discussing ways to help the community both in the marketplace and in the regulatory environment. So let me start with you, Cromwell. Your exchange represents probably by far the largest number of microcap issuers in terms of number. What can we do to help promote capital formation in your markets?
So, I look at it, how do we promote more companies being public? And it's really two related but different issues. And one part is for companies that don't need capital. The public markets of companies that are profitable, that they've already raised capital, and they want to become a more sustainable company. They want to be better connected with their community, with their communities and their stakeholders. And for the last 20 years, we've been making it more and more painful to be public and giving a free pass to the private markets. And that's completely undemocratic because public companies are transparent. The public can own shares in them. They become more sustainable. There's public governance. The press can oversee them. But that's been the regulatory world. So that's one side. The second part is access to capital and companies that need capital. And they're the parts that you see more in the public markets. And for there, it's how do we lower the cost of raising capital? OTC Markets is an incredible beneficiary, as are all the other electronic markets up here, from the technology stack that has come to trading stocks that are already issued. Raising capital is still an analog business, the new issuance. We need to change the regulatory framework so we can use the efficiency of technology. And most importantly, as with smaller public companies, if you're what's known as a WIXI, which is a well-known seasoned issuer, it's a very, very large public company, you can do ATM shelf offerings, where basically you go through the registration process, and whenever the market price looks attractive, you can sell directly into the market, very close to the market price. This makes markets more efficient because who knows if a stock is overvalued or undervalued is the company. But we have, if you're not a WIXI, and as you move down, it becomes harder and harder as a public company, you're actually forced to go into the private market and raise capital at prices that are completely disconnected from the public market. And there's a class of intermediaries who provide a service of giving firms capital, warehousing it, and then putting it into the market. So we need to reconnect those dots. And I am, on Tuesday after the change of administration, we were in the SEC and going, we need to take Reg A and turn it into a mini ATM offering. So any company that is SEC registered can have access to capital directly into the public market.
Right. So in that regard, we're going to come back to those intermediaries who have become somewhat controversial in the regulatory space. But Paul, how do you see the capital formation process occurring for the, what we've talked about as the microcap space, which are, companies, call it $250 million and under in market capitalization, going down to, as low as, $5 or $10 million. You're seeing new listings. You're reviewing the requirements to see if they make the requirements for NYSE American. Are you seeing an uptick, a downtick, and also what are you seeing in terms of is it becoming more difficult? Is your exchange raising the bar, lowering the bar, moving it sideways? What's happening over there?
Yeah, there are always entrepreneurship, right, is part of the American culture, right? Part of being American, building a business and then, from the start and then growing it and needing capital. And then at some point, perhaps being a publicly reported company and having access to public and permanent capital is something that's important to your growth life cycle. And then they give us calls about being a party to that process. And so my phone is always ringing, right, from executives and advisors about joining, listing and all of that. But it's very difficult. So I've seen, there's the regulatory apparatus, right? And I think if anything, it's getting more, not the word restrictive, but the requirements. I think the zeitgeist, fancy word of the day, is to look for larger companies, maybe better companies, if that means, if they're synonymous, but larger in terms of the float value, the balance sheet, and things like that. That's sort of the trend versus, at least for an exchange listing, is going that direction. It's going north. So it may not, it probably won't get easier to become a listed company. But nevertheless, entrepreneurs will continue to want to do that. But it's really, it's kind of a long story, right? It's just getting listed or being public is just the beginning of the story for many of these, the experiences for the investors and the executives and the board, because at that point now you're public and you have a lot more responsibilities, and that's not going to be any easier either to get and stay. Sometimes getting anything is easy. Holding on to that thing is always more of a challenge. So that said, there's still a lot of interest in having access to capital on a variety of platforms.
Thanks, Paul. And so, Philip, why don't you tell us a little bit about your exchange and its opportunities for small businesses looking to go public that are based here in the United States or in Canada or wherever. One option is to, if they want to be a publicly traded company, is to go onto OTC markets. One option is, NYSE, and one of them is NASDAQ, who's not represented here today, but many people are familiar with. Many companies here are listed there. Why list up in Canada?
Okay, the CSE has been around for about 20 years at this point. So we have approximately 800 issuers. We, being in Canada, have a higher concentration compared to a lot of the national exchanges here in the mining space. Obviously, if you are in mining or if you know anything about mining, the process can be quite long, meaning that you buy a property, and from the time that it starts to get commercialized, it could be 10 years. So the Canadian capital markets have supported a lot of that over the last little while, and gold being at its all-time high right now is quite it's quite attractive. But to answer the question, the major reason that one would want to go to Canada is because we provide a it's a regulated stock exchange. Secondly, there is the ability to get listed in Canada at Canadian rates, meaning that it's a lot cheaper, relatively speaking, and it's what about a 45 to 50% discount for for American companies to get listed in Canada, and then partner with the OTC markets, where of our 700 some odd companies, about 500 of them or 550 are OTC listed, with about 230 or 240 of them OTC QX or QB, which then allows you, of course, to have access to Canadian retail as well as Canadian institution funds, but also U.S. funds as well, or the U.S. investors, and of course international investors as well. But what the opportunity really comes from the ability to be able to get listed in Canada, learn to become a pubco, especially for those companies who are fairly new, for the management teams who may or may not have done it before, and then ascend to larger exchanges.
Got it. And with those larger exchanges, they could be either up in Canada or here in the United States?
Correct, yes.
Okay.
Yeah. In fact, we've actually got 7 listed with NASDAQ, dual listed with NASDAQ, a couple listed with Aquis in London, but nothing with the New York Stock Exchange just yet.
There's hope.
Yeah, there's hope.
Well, we'll get there.
Yes.
We'll get there. So we talk about accessing these public markets and these exchanges that you gentlemen work for and are very involved with. So there's different ways to get there, right? We talk about the traditional sort of gold standard is the initial public offering, whether it's a best efforts or typically underwritten public offering. I would imagine, Paul, you see many of those. How about on the other exchanges? OTC markets, is that one way to get there? Is that a common way?
So the path, you have to look at OTC markets, 2 different groups. There's 90% of our dollar volume is trading international securities. ADRs and ordinary shares. There's great CSE companies. There's lots of great markets for capital formation around the world. And then we've got the ADRs for Roche and Adidas and Heineken. And we provide a very cost-effective way for an international company who already has a primary listing to distribute their disclosure into the U.S. and data into the U.S., to have access for U.S. dollar trading, and 3, we feed the compliance engines of all the major clearing firms and broker-dealers so they can go through and remove or add risk controls based on the size of the issuer and other areas. So those 3 things, if you're a public company, you can look at the traditional exchanges. It's this room, and you get to ring a bell, and Bob Pisani's there. He's fantastic. But in reality, it's some functionality, which is, and for the issuer side, is a model for consistent information distribution so investors can value the securities, a place for broker-dealers to trade these securities, a data distribution network so everybody else can see the prices that are going on in the information, and 4th, the ability to introduce a new security into the market and check the boxes that the regulatory side is. So for us, that international one, we've got an incredible model. It's fantastic. And with the world, with capitalism, working in different places, we're always going to have a really cost-competitive offering. The second part is primary listings. And for those, it's mainly what I would call direct listings. Companies have raised capital before, they've seasoned, they've come to rest. We have a very strong market in community banks. We win more from the exchanges than we lose. And for there, we offer just a really cost-effective way to be public, support your shareholders without a lot of the extra overhead. Because the New York Stock Exchange's fundamental business is being a fantastic market for the S&P 500. Smaller companies have different information flows, needs, and we've really been able to focus on a data-driven style. And so the idea that you're going to go do an IPO to the public markets, to the OTC markets, is Instead, you've raised capital, you've got investors, you want to give them liquidity. The issuer either wants to support it, or we've got our pink limited market where investors who have shares can call their broker, and there can be a market with limited to no engagement by the company. And we protect investors' rights there. So those are the different ways in. We are, if you want to raise capital from a bunch of investors who you have no relationship with, it's easier to do it on an exchange. That's straightforward. Now, if you have a good story and you've got good investors, you've got anchor investors, and you want to be public without all the cost and complexity, we're a fantastic market.
Thank you. And so, Paul, I know that you guys have seen it's been an interesting trend over the last maybe 15, 20 years. For a long time, the New York Stock Exchange and the predecessor, the American, they were focused on bigger and bigger IPOs, starting in the dot-com era and then moving up until the 08 crisis. Yeah. And over the last 5-10 years, you've seen this sort of increase in what we'll call the micro IPO, where you're doing an IPO not for $100 million or $500 million with a multi-billion-dollar valuation, but rather an IPO for $15, $20 million and a market cap that would fall within what most folks here are looking at. Right. What do you attribute that to?
I don't know. It was kind of there when I started doing it. I would say the average IPO proceeds have shrunk for whatever you want to call small cap. If you take anything that's not, let's say, and qualified for the New York Stock Exchange or the big board, but it's more NYSE American sized. Maybe it's not the company. Maybe it's the companies are somewhat similar. They're just able to raise less money versus because you are your market cap. What the market tells you are, what you can raise and how many shares. But it is small, and it has been shrinking even over the last 10 years, to the point where we were doing like $10 million. We're doing $10 million IPOs now, and in some cases, early in the last few years, even smaller. Which you start getting used to this smaller number, because it's like incrementally, and then you kind of look and realize how small some of these IPOs are, and the market caps are, and then it's a real challenge also. So it's not necessarily a good thing. There are arguments to me at both, on both sides, that you're just too small to be public, or well, if you're small and you have a high risk profile, high risk return profile, it's good to socialize that, right, and have lots of investors losing a little bit of money potentially, or making a lot of money, versus a small group of investors taking that risk, even though they might be more qualified. But it absolutely has been the trend. I think we're at a bottoming out in terms of that, in terms of being a public company. That said, will bigger companies now go public? Will we see 25, 50 million? Again, for the small cap community, will they be 25, 50, $100 million IPOs coming in? Maybe, but an early phase 2 biotech is going to have to be able to show up with that valuation,
right,
and be able to command that valuation and that amount of proceeds. So, everyone's always at an inflection point or a fork in the road. It's been that way 10 years, but I feel like we are there now, and I don't want to give my opinion, but because there's good opinion on both sides, whether they're too small or they're right sized. So I'll just leave it at that.
But that's, we've been in an environment for the last 20 years where, microcap has been a derogatory term. Right. And there's been regulatory redlining, and you hear about the crypto industry debanking. There's been debroking and declearing, and not based on the individual issuer's compliance with securities law, but on characteristics driven by regulators who have not been especially capital formation friendly. So the interesting part, because we don't control the rule book, is there is a new group in town, and there's at the SEC, And there's an agenda to shrink the administrative state overhead. And you're hearing a lot of news about how we're going to have fewer federal employees. The real part is what's going to happen to shrink the rule book to what matters. Because at the end of the day, they go after you for anti-fraud, 10b-5 if you're an issuer, and fair practices if you're an intermediary, if you're a regulated broker-dealer. And what do they do to remove drags and, again, open up capital raising and make it more attractive to be a public company than a private company? And that's, you know, I have opinions of where we want to go, but that's going to be run once we have a new SEC chair. And he, you know, the good news is Paul Atkins, the other two Republican chairs, work for Paul Atkins. So it's going to be a very aligned commission trying to bring back market forces rather than merit regulation.
You know, it's interesting, just for everybody's edification, you know, Paul Atkins was a commissioner back during the George W. Bush era as a Republican nominee. He is the current nominee of President Trump to take over the position that Gary Gensler just vacated. And he's generally considered to be much more industry-friendly than Gary Gensler was. In addition, typically there are 5 commissioners. Right now, once he's appointed, assuming his confirmation goes through, there's only going to be 3, and they're all going to be Republican. And the other 2, by law, are supposed to be Democrat nominees, but query whether or not in this current environment and with this current Senate, any Democrat nominee is going to actually get appointed by the Senate. So it'll be an interesting scenario on that front. I want to come back to these regulatory issues because they're very important for this community. You know, I do note that there's been a very big stigmatism that has been discussed here on other panels that I would listen to, that you just mentioned, Cromwell, and this notion of whether or not microcap is a good marketplace or a high-risk marketplace that needs, you know, historically the regulators have said we need heightened levels of scrutiny because of the unique risk to microcap. I think, you know, I know Cromwell and I agree that that is, you know, something of a misnomer, that, you know, certainly, you know, we all saw the run-ups and potential, you know, however you want to characterize GameStop and AMC when they had those big run-ups that they made the movie about.
But let's put there with GameStop and AMC, investors had an exuberant view of the future. They did lots of ATM offerings into the market. And so the capital, they were able to raise capital at the price investors were willing to pay in the public market in a very efficient manner and make a bet. And it went into the company's coffers really efficiently. So, and the second part is, and this is where I go back to the shelf offering, is during the GameStop AMC meme stock frenzy, there was also something else happening. There was a family office buying derivatives, really running up prices, and using it to run up prices. And what broke the fever, because the, you know, AMC and GameStop didn't do shelf offer ATMs right away. What broke the fever was CBS Viacom, whose stock was being run up by the family office, who is now, you know, convicted of market manipulation and fraud. Is they announced a shelf offering, and they did it 10 points down, and that broke the fever of the market. And it was an incredible, you know, that part of showing of giving issuers the ability to sell directly into the market, and as part of the participation of the liquidity, is really an opportunity to improve price formation and not have these moments where every once in a while a company without that big, with a smaller company, there's a lot of demand, but there's no supply. And it turns America's public markets into the greatest capital formation machine in the world.
And so, before I want to come back to that in a second, but I do want to ask Philip a question. How does one become a publicly traded company on the Canadian Securities Exchange?
Okay, well, you need to be a Canadian reporting issuer, so which is different from obviously a U.S. reporting issuer. We have our own commission structures up there. We don't have an SEC. We have provincial ones. They're the Ontario Securities Commission and the British Columbia Securities Commissions are the largest ones. Really, the two major ways to do it are very similar to here in the U.S. You can do an RTO, reverse takeover, so private company takes over an existing publicly listed company or a company who has previously been a publicly listed company, but is not traded anymore. So the reverse takeover has been a very common way of actually going public, but actually recently in the last 3 to 4 years, we've actually seen a lot more prospectuses. They are generally speaking smaller in size. A full-on prospectus is a listing statement has to be put into one of the local commissions. You keep the CSE abreast of what's going on, and bing, bang, bong, 6 to 12 weeks later, you get conditional approval from the commission, and then you're listed in Canada, or at least on the CSE. So one of the structures that has actually been very popular is companies, when they're doing a prospectus, they will get together their number of shareholders and then partner with a private shell, which is just a collection of shareholders so that you can meet your 150 shareholder minimum requirement. And once you've actually raised enough money to get public, that amount is, as a minimum, is 200,000 Canadian. But realistically, you really should raise a lot more because it's really not a lot, especially even in Canadian dollars. So, and then of course you've got to be an operating business. So we say operating business because within Canada there's a program called the CPC, which is the Capital Pool Company, which is essentially like a mini SPAC, but it's run through one of the other exchanges in Toronto. So they offer a pathway for companies to actually get public there. All of our companies are all actually operating companies. So when you apply to the CSE, either the RTO or if you're going through the prospectus format, they're all actually up and running companies. They may not be very large, but they're up and running. So they're not shell companies.
Got it. And so, of course, the other way that you mentioned, which is the RTO, can also happen on both the OTC markets and on the NYSE American.
Yep.
There have been some rule changes from the last commission, led by Chairman Gensler, that put quite a few new restrictions on or additional disclosures or additional requirements for reverse mergers and de-SPAC transactions. As a result, did you start to see a lower number of those transactions, or was it pretty much business as usual, or was there even an increase?
Well, I mean, the SPAC business just got, put on hold and then blown up by Mr. Gensler. And, this is, I look at it as, in the in the secondary trading world, we've had a conversation with regulators, between the commercial people in the industry and the regulators. And we are always coming at it from a different perspective because the commercial side of the business, the broker-dealers, the market operators, they want more good things to happen. And the regulators are like, we don't want any bad things to happen. But we've had a view of technology and transparency, and we've really improved the trading side of the business. Capital formation is a really tough conversation with regulators because they don't want anybody to ever lose money. And the skill sets within the regulators of understanding the fundamentals of how stocks are valued, capital is raised, is less and less. is especially, the index fund is an incredible invention as a savings product. However, if your regulators only own index funds, they have no idea how to do fundamental security analysis. They have no understanding of how the market works because they own this index fund, skims the cream off the crop, averages up the winners, sells the losers, and they don't get the whole bottom of the pyramid that feeds it up, all the little fish that go in to create the 500 biggest stocks in the system. And that's a hard conversation. So, SPACs, again, we were having a conversation to say, where do we need to put some transparency into the market so the market can do its job of getting to the right price? And versus they say, no, stop this, it's all bad. Or we don't like this, so we're going to put our thumb on the wheel. And that shouldn't be a regulator's job, even if, the regulator used to be an analyst for Bill Ackman. They should be looking, how do we get the information in the market so the market machine and all the different viewpoints can go through, and does anybody have their thumb on the scale? Or is there anything hidden? Are there any elephants in the room that are hiding in the dark? And that's a much easier job to solve. Are there places, are you putting governance rails? Are you putting holding rails? Are you putting different sides? But it was and this is where I am hopeful that the next regulatory regime is we're going to have rational conversations about capital formation.
So one of the things I want to ask you guys, I'm sorry, go ahead, Paul. You're gonna.
No, I think a lot of it is like about disclosure and registration statements also. We all look at lots of them, and you'll go through an S1 or an S4, and like the first of all, there'll be 50 pages of risk factors to the point where they're meaningless because they're mostly boilerplate, right? Where everything's going to go wrong. Anything that can go wrong will. And then you start seeing like sections on revenue recognition and intangible assets, and you could go through like 30 pages if you even get that far before you actually even know what the company does.
Sure.
Right? You I go through them like, okay, no, I don't know who they are, what they do. And then, right, it's page 70 where it says, our business. And then even then it's a little bit puffery, whatever it is. But like there's a summary section to these documents, and they're not summaries at all. I mean, there are ways really very easily done where you can describe your business in plain English with your plain English description, commentary, financial statements, forced to highlight the most important metrics in financial statements, then the management and their experience, all at the front in the first 2 or 3 pages. You could even say something like, if we go public at, if we sell 10 million shares at 5 and we end up having 50 million shares outstanding at 5, our company is being valued at a number, right?
Right.
And look, a lot of this is more just like, not wishful thinking, but just thinking, right? Mentally just going out there, the average public company in our sector is valued at this, either at this number or at this ratio, right? So an investor can say, this is interesting, this is very highly valued or very undervalued. I know what it is, and I can size them up, as opposed to saying this stock is going public at 4, and that sounds like a small number, which means it's pretty cool, so give me a lot of shares, right? Like,
Sure.
they don't have a sense of what their, the value for their $10,000. What are they getting? Half a company, 1/1000th of a company, and none of that. That's like the most important thing, I think, for an investor, right? Whether it's not protection, but it's education and disclosure, and that's almost nowhere in current registration statements.
Well, and that's a good point.
In my view,
that had been brought up previously. Our securities laws historically have been designed to promote disclosure, and in some blue sky states and some states have a different approach, which is called a merit approach, which is somewhat of a paternalistic view that says, well, we as the government are going to put in fundamental restrictions based on what we see as fair to the retail investor, what I like to call the Widows and Orphans Club of Peoria, Illinois, the people that everybody points to when they look at the typical investor victim, right, is some poor old widow in middle America who's lost her retirement fund investing in, XYZ Co. or Acme Company that didn't go anywhere. And I think, in these markets, in a microcap, there's a general understanding that these are volatile stocks. They're higher. The companies are generally younger, smaller, less developed. I mean, it's small business. It's entrepreneurship. This is what this marketplace represents. Yet, the access to capital and the barriers to capital, in many respects, is much higher than it is, for 3M or NVIDIA or a well-known seasoned issuer, right? One of the challenges that we've seen more recently, and I'd say in the past 10, 15 years, is there's been a challenge with liquidity. Once the shares are out there and once investors are in the stock, it's I've seen sort of a contraction of liquidity across microcap in general, with some few exceptions when it appears that algorithmic trading gets involved, and then all of a sudden you'll see this massive spike of volume in a stock that normally trades 50 to 100,000 shares, 200,000 shares a day, will have a day where they trade, and I have a couple of examples where they literally traded 100 times what their entire outstanding share count was in a particular day. So first of all, what do you attribute the typical day-to-day restrictive liquidity to? And then these huge spikes, I mean, is it really just algorithmic trading? What's happening there? I'll ask any of you guys.
Very briefly, right, there's technology is now in place where it's frictionless to trade. Software, sophisticated black box trading firms can both create and benefit from their own creation of trading, or more volume begets more volume, and it's based on nothing linked at all to the company, right? And why they don't trade much is because there are very few shares in the float. There's still some good percentage insider ownership, and they're unknown. Certain investors can't invest in them either, right? So it becomes just a retail product, and it's.
Well, that's an interesting point, because we know that at least at some level, on OTC markets, for example, many of the brokerage firms won't accept deposits of these shares. Cromwell, we've had a discussion about that before. What is it that is keeping these brokerage firms, the large ones where people have apps on their phones, from people? Why are they restricting somebody's right to get into these shares?
Well, they're restricting, their share deposit, and if you're a broker-dealer and you give investors free trading, like there's no way you can do the diligence needed for new fresh shares coming to the market. That's a service that has to take place, and they're nervous of illegal distributions circumventing securities law, but AML has been the blunt club of enforcement and it's been used more and more as a merit regulation to not chase after the people who are doing the bad things, who are actually breaking the rule, but the facilities of the lawful financial markets service providers.
And just real quick, for those who don't know, AML is anti-money laundering regulations.
Yes. And it's very tough. It's very hard to tell when an investor shows up with a certificate if you don't have a relationship with them. So how do we do that? I mean, and it's a mix. If you're a community bank, if you're not a penny stock, if you pay a dividend, those problems are not there as much. But if you're a small company trying to raise capital and you're raising capital from people who have no other brokerage relationship, it's not going to work out to be a great experience. So how do we fix that? I think it is a technology and having an adult conversation with regulators, because if securities laws have been followed and the disclosure is out there, and it's easy for a regulated entity to see that that's been demonstrated, we should be able to unlock the problem sides, that, remove the problems and start having the flows through again. But it's, for the past few administrations, and, the previous Trump administration was, the SEC was really trying to improve the capital markets for the blue chips. They weren't focusing on small company capital formation, because entrepreneurial small companies are not the people on the membership committee at the country club. They're the people who are trying to make it, and that's, what makes America incredible and if you start saying, if you start imposing these at the smaller part of the market, you're really just closing off the capital formation club to only the biggest companies, and that's undemocratic. And that part is being public, you get transparency, and you get to build a track record. Some people will disappoint, some people will overtalk, but if the market should be able to get to the right price. And that's, we have to understand these securities are a risky product and they're a retail product. We can't de-risk them. We can't turn them into something that giant investment funds buy. So how should we have them so they can exist in a safe manner but allow capital formation? And don't, easy thing is, if the widow wants to put her whole retirement into one small stock, there should be some checks along the path. And if she wants to speculate with 5% of hers on one, go for it. She might know more than the regulators.
Mark, we're out of time. If you'd like to take some questions, though, before we end.
We'd love to.
Here we go.
I think the comment about listing in Canada first, especially for the smaller companies, and then upgrade later on to the NASDAQ or the New York Stock Exchange is spot on. How do you feel, I know you're in the CSC, how do you feel about the CBOE, the CBO, Chicago Board of Equities, which has, they're backed by the CME, entering into that market with their acquisition of the NEO, and now they're listing a lot of companies in Canada, and of course with hopes to upgrade to the U.S. markets.
Okay, so for those that don't know, there's actually two tiers of stock exchanges in Canada. We have venture exchanges, and then we have what colloquially we'll call them senior exchanges. So the TSX and CBOE are that. The CSE has actually also added a senior tier now as well. So we have a venture and a senior tier. To answer the question in terms of CBOE, CBOE's been around for I think about 6 to 7 years in the space. They have approximately, if I'm not mistaken, about 70 issuers, and it takes a lot of time to actually build a stock exchange. And understanding the whole listings requirement facet and understanding the continuous listing requirements there afterwards and maintaining an efficient process for that is very difficult. They have, they've certainly have had some success. They have a big brother who is well capitalized, so that's very, very good for them. But what's happening at the venture level is that the CSE has actually added a good amount of companies over the last little while. In fact, if I'm not mistaken, in the last 6 years, we are the fastest growing stock exchange by number of issuers over the last 6 years. In 2021, we added 181 issuers. So yes, they are mostly smaller in size, And SIBO typically is going to attract a slightly larger one, but they're also, what we've seen is they've kind of come down market a bit and started to look at like the slightly smaller issuers at this point. But we certainly, we do have conversations with some of the issuers that decide to either go to us or go to them.
Any other questions? All right, let's thank our panel.